Hello viewers, today we are going to resume our series on management decision and control. And what we are going to look at now is what we call perfect and imperfect information. This is one of the things that we had to look at when we looked at when we are trying to finalize the risk and uncertainty in decision making. And this is where we are going to pick some of the key items that we need for us to be able to understand some of the key items that are involved there. So without wasting more time, let's kick off and see what we mean by perfect and imperfect information. We are seeing that perfect information is the kind of information that is got through engaging consultants, engaging professional people. In other words, through carrying out market research and other items that we can be able to carry out so that we can be able to have that perfect information. So it is the information that we get through engaging the professional guys, like the consultants, through doing market research and other items. It helps us to change the decision makers' environment from uncertainty to certainty. Remember, the topic we are looking at is risk and uncertainty in decision making. So if you have that perfect information, it is going to help the decision maker, or is going to help you to change the environment from uncertainty to certainty. In other words, perfect information is the forecast of the future outcomes, which is always a correct prediction. The reason why we are getting this perfect information is because we want to make a perfect decision. So if the firm obtained perfect information, it will be able to undertake the most beneficial action for that prediction. If, let's say, you have done some research on a given kind of topic that you wanted to look at, the information that you are going to be getting is what we call the perfect information, because it is information that has been researched and it can help you to make correct decisions. On the other hand, when you look at the imperfect information for it is not as valuable as the perfect information, because it doesn't use 100% accurate data. In other words, you make decisions basing on maybe answers or maybe situations. Maybe if I start this business, I may be able to get profits. But when you have not actually made research about that kind of business that you are going to involve yourself in. So perfect information we base on 100% accurate data. But when you look at the imperfect information, for it, we make decisions, but we don't base on 100% perfect or accurate data. So when you have gotten the information that we have, we compute what we call the expected values, because we've been computing the expected values, and those are the things that have been helping us to make decisions on on areas of risks and uncertainty. So the expected values computed without perfect information will yield imperfect information. In other words, if you compute the expected values and you base on the data that is not well researched, or you have not got it from the right source, it may yield imperfect information, or it may give you wrong results. So when seeking perfect information, a firm incurs a cost. Because if you want to know if I'm to invest in this kind of business, am I able to make profit? If you are looking for that kind of information, it means you have to go ahead and look at more information that you are not just going to obtain for free, meaning there is a cost that you are going to incur for you to be able to receive that perfect information. And the expected value of perfect information, what we call the EOVPI, that is expected value of perfect information. That is the price that one is willing to pay in order to access the perfect information. In other words, the expected value of perfect information is the amount of money someone is willing to pay in order to get that perfect information. So that expected value of perfect information represents the maximum cost a firm can incur to obtain perfect information. And we have a formula to compute that. And the formula is actually we are getting, for you to be able to get the expected value of perfect information, we get two things. We have to be having the expected value with perfect information, that is EVWPI, minus the maximum expected monetary value. In other words, the maximum expected return, or the expected value. So we need to be able to, we shall look at that formula in details, but as of now, what you need to get is that for you to be able to get to compute how much can I pay for a given perfect information, we get the expected value with perfect information, we less the maximum expected monetary value. And the expected value with perfect information, for it represents the benefit. In other words, we are just reflecting the benefit. What we expect to get from that perfect information is what we call the expected value with perfect information. In other words, it's the value that is coming after the decision maker using that perfect information. So we may be having maybe some of the simulations that we are going to use to be able to understand some of these applications, but that is going to be at a later stage. So let's try to dive in and try to look at maybe giving more lights, throwing more lights on the key items that we spoke about, that we are seeing in our sheets here. We have two terms here, and these two terms, they normally confuse students. We have the expected value with perfect information. That is one of the key items or the key terms that we have. The expected value with perfect information. And we also have the expected value of perfect information. So those two items, they normally confuse students. But I want to make clarity on some of those so that you can be able to understand what we are actually dealing with. So when we are looking for perfect information, we said perfect information is that ideal information that you need to make the best decision. We've said that the perfect information is actually that ideal information. In other words, the maximum information that you need for you to make the best decision. For example, we can try to look at maybe an example. That's where maybe you can be able to pick it right. If let's say you're a student and you have decided, let's say June in June sitting, I'm going to sit for a given paper for a CPA course. Let's say you are going to sit for this same paper that we are handling, management decision and control, MDC. And that paper, you of course you normally pay tuition to make sure that for you can be able to get to attend classes. And when you attend classes, you can be able to attend classes somewhere. It may be from it may be a private tutor, it may be from a given school, it may be anywhere, all the different tuition providers that we have. So if you have decided that I'm going to do MDC, and you normally the usual item is that you are supposed to pay someone, or you are supposed to pay somewhere for you to attend classes. And the reason as to why you want to attend those classes, or you are paying money to attend those classes, is because you want to attain perfect information. In other words, it is that information, or it is that ideal information, the maximum information you expect from that, get from that tutor or from that college, so that you can be able to pass that exam that you want to sit. So the reason as why you are going to pay for classes is because you want to obtain the knowledge that you are going to use to enable you pass the exam. And that knowledge that you are going to get, if it helps you to pass the exam, we can say that you have used the perfect information, because you've gotten the right information that has enabled you to pass the exam. So the perfect information is that information that helps to change the environment from uncertainty to certainty. We need to understand some of the things. When someone says uncertainty, what do we mean? For instance, when someone says, I've gotten the information that I need, and that information is helping me to move from the unknown to the known, to the known position. In other words, I'm moving from uncertainty to certainty. In other words, certainty means if you get the information and the information cannot help you to move from the uncertain position. The uncertain position is that position where you actually don't even know what the outcomes of that decision you are making are going to be. In other words, if you want to go and bet on a given club, you don't even know the outcomes, how the outcomes are going to be. But if you base on certain statistics that have been, maybe you have gotten some analysis, They have given you, maybe you have, based on the previous meetings of those two clubs that you are going to bet on, you can be able to have a perfect information, though it will not be 100% perfect, but at least you have made some research. So the uncertainty here, we are looking at that situation where you actually don't have any information about the outcomes. But the certainty means that you are sure about the outcomes, having obtained the perfect information, because you can only be sure about a certain transaction when you have actually gotten the right information that you need. So the perfect information is going to help you shift from the uncertainty to certainty position. So that's the perfect information. And on the side of you seeking for going in for classes to be able to get that information that is going to help you pass the paper, is that information you are looking for is what we call the perfect information. Maybe we can look at in terms of business. We can get another example from the business perspective. We always say that for any business, or it is always assumed that for any kind of business that you want to start, you can't just wake up just because you have money and you say that I'm just going to start such and such kind of business. So what do we normally do? We always need to, first of all, do market research. Market research can be in different ways. You can do market research when maybe you are consulting people. You can do it by yourself, or you can do it in terms of consulting other people. But these people, they are the ones that are going to give you ideas. Say, maybe they may say that if you start this business in this place, we've seen that people who have already been doing that business have been making losses. All those guys who have been doing this business in this same location, they have been getting losses. So they may also give you the other alternative, that if maybe you start this business, then you will be able to get some profits, or you will be able to make profits. Because those people, they have actually given you the information that if at all you came with this business idea in this location, the people who have actually been doing that same business before, they have been making losses. But if you do this kind of business, then you will be able to make profit. It means they have given you more light. You came with a different idea, but for them, they are giving you what is actually happening on the ground. So, because these people, they are going to tell you which kind of business that can work at that particular location. It means they are not just going to just tell you that you start this business, but they are also going to give you the results of those people who had actually engaged in that kind of business and they have actually made it. They also go ahead and give you the do's and don'ts, the things that you are supposed to do and the things you are not supposed to do. Maybe they may tell you that people within this place, if you give them credit, they will not actually pay. It may be one of the reasons why other people have been failing. They give you what you should do and what you shouldn't do. So it means they give you the information that is helping you to make an adjustment in the decision that you had. That information they are giving you is what we call the perfect information. And by you doing those consultations from different people within that given location that you have chosen, is that what you're trying to achieve is that you want to be able to get the perfect information. Because it is only that perfect information that is going to help you be able to make the best decision. And the only information that is going to help you do that is that perfect information. So hope that gives you a more light on, it throws more light on the perfect information, as in terms of the given examples, that the live examples that I've actually given you. So let's try to look at the imperfect information. Let's try to look at the side of the imperfect information. What do we actually mean by imperfect information? We are saying that imperfect information, for it, it's based on information that is not very accurate. Meaning, the imperfect information, it's based on the information that is not very accurate. Because if a person gives you the perfect information, also that person is going to give you the statistics. In other words, that statistics is what we've been talking about. Someone is going to give you the if the person is saying that if you have to start this kind of business, he or she is going to actually go ahead and give you the insights on those people that started that business that you are proposing to do before, and what was the likely outcome they got. So it means someone who is going to give you the perfect information is also going to give you the statistics that maybe the people who have been in this business, this is their performance. And without telling you that this is their performance, that person is also going to give you their financial statements. If that person gives you the financial statements, it means the person is actually giving you evidence to back up what they are actually saying. Because if someone just tells you, if you are going to do this kind of business, it may not work out in our location. You may find it unclear until the person gives you the financial statements of those guys who have been doing that same kind of business. That is going to act as an evidence that what they are actually saying is true. But for imperfect information, it is based on the data which is not 100% accurate. Probably someone may be giving you maybe answers. For example, maybe someone may say, maybe if you start this business, you may get profits or you may not. So it is a just maybe answer. They are not actually giving you the right information that you need. Because we've seen that that person is not actually telling you the exact thing. He's not actually telling you exactly what you should do. Hence, that information is going to be incomplete and imperfect. Because information that is just in a maybe situation, they are going to leave you with no option, because you will just make a decision anyhow. But with the perfect information, you are able to make the right decision. So if you gather the information and you based on those maybe answers that if you start this business, it may be profitable or it may not. And you go ahead and start that business. If you go ahead and start that business when you have actually based on imperfect information, then that means you don't actually know what the outcome is going to be. And if you don't know the outcome that is going to or you don't actually know what is going to happen, then it means you are in uncertain situation. So when we talk about expected values, now I want to be clear on the other two words that are confusing students. The expected value with perfect information and the expected value of perfect information. When we talk about expected values of perfect information, we said it is abbreviated EVOPI. We say the expected value of perfect information is the cost you as a decision maker you are willing to incur to get that perfect information. In other words, it's the cost that the decision maker is willing to pay for that decision, for that perfect information he or she has received. So, since it is not always free, in other words, that perfect information you are supposed to pay for it. It's not always for free. So, since it is not always for free, then it means we need to attach a value to that to that information that we have actually received. So we can try to look maybe to a small example to be able to clarify on this. Someone may say, let me just assume that you have approached a consultant and the consultant told you, if you want this perfect information, you are going to give me 2 million, or I'm charging 2 million for me to give you that perfect information that you need. But you find that for you, the person who's actually needing that perfect information, you can only afford 1 million. If you find that you can afford only 1 million, then that means that the expected value of perfect information is going to be 1 million and not the 2 million, because the 2 million is what the consultant is asking, but for you, you can only afford 1 million. It means on your end, the expected value of perfect information is going to be 1 million, because that is the amount the decision maker is willing to pay for that perfect information. They're asking you for 2 million, but for you can only pay 1 million. So if you can only pay 1 million, it means the value, the expected value of perfect information is going to be 1 million, not the 2 million someone is asking. So it is always what the decision maker is willing to pay for the perfect information. In other words, we don't consider what the other people are asking for the information they are going to give you. We only consider what the decision maker is willing to offer. And that's what we call the expected value of perfect information. Another example we can base on, since we are students, we can maybe say we can maybe try to get this example from the tuition. The tuition we pay for the different CPA papers. If you want to attend a certain college, for you to be able to get that perfect information that is going to help you pass the exam, you may reach at a college and they tell you, for us, we charge 300,000 per CPA paper. We charge 300,000 per paper for any for CPA course. And for you, the person who, or for you as a student, you can only afford 100,000 per paper. So if you can only afford 200,000 per paper for each course unit, it means that you will not get the perfect information from that college, because for them they are charging 300 and for you can only afford 200. It means what you are going to do, you are going to look for another tuition provider who can actually accept what you are offering. Because for you, you think, oh, you can only afford 200,000 and the other person is charging 300,000. It means you are going to look for somewhere. In other words, the expected value of perfect information is going to be the 200,000 that for you are able to pay, not what they are asking. Because they will not give you that. Maybe if at all they give you a discount. But here we don't base on those discounts. We base on what actually the person is willing to pay. In other words, the buyer or the decision maker. So, in other words, maybe we can try to look at more on the examination side. Because the examiner may give you scenarios. The examiner may give you scenarios. The examiner may say that there is a consultant willing to give you perfect information, but he has issued you an invoice of, let's say, 20 million. And they tell you to advise the company on whether they should hire the consultant or not. In other words, the consultant is available, but the consultant's quotation or invoice is 20 million. Now they want you to find out, will that company be able to hire that consultant? So that means for you to be able to have that question done, the examiner is actually directly telling you to compute the expected value of perfect information. Because once you compute the expected value of perfect information, then you can be in position to tell how much the company can afford to pay for that information. If you compute the expected value of perfect information and you find that value is, let's say, 5 million or 10 million, but the consultant asked for 20 million, it means the company can only afford 10 million, which means they will not be in position to hire the consultant because they cannot raise the money the consultant is asking. Hope you can be able to get that. If you have not understood, please do watch the video and be able to pick it right. But what basically this expected value, because I'm emphasizing on this because this is basically what you are going to find in an exam. The other perfect and imperfect information, for them, they are going to be a bit theoretical, but these are just computations. But there is no way you can compute something you have not understood. So that's it. Having understood the expected value of perfect information, then let us try to look at the expected value with perfect information. The only difference is in those two words. The other one has of, this one has with. So we need to get to these two meanings and we get the difference that is there. We said the expected value with perfect information. We said that is, it represents the benefit as a result of someone using the perfect information. In other words, the benefits that you get from the decisions you've made when you have used the perfect information. That's what we call expected value with perfect information. It is the benefit that you get after making a decision to use the perfect information you have acquired. So we are concluding that the expected value of perfect information is the cost, and the expected value with perfect information is a benefit. So that is the first difference. The expected value of perfect information is a cost, what you are willing to pay. But the expected value with perfect information is a benefit.